Hi, and welcome to our 2020 College Fed Challenge. My name is Edmund.
I'm Tom.
I'm Ray.
I'm Jessica.
My name is Christian.
Our first policy recommendation is to maintain the federal funds target rate between 0.25% and 0.25%. Second, we want to continue to use forward guidance for future monetary policy tools until we can reach our dual mandate goals for inflation and unemployment. And lastly, we want to continue to use the current rate of purchasing securities to sustain market function and to also support credit flows to households and firms through quantitative easing. Our policy recommendations are in accordance with the goals of the dual mandate for the natural rate of unemployment and also 2% for inflation. The coronavirus has had a significant impact on the dual mandate, drastically increasing unemployment and also drastically decreasing inflation. This has sent the U.S. economy into another recession. Although the significant impact the coronavirus has had, we believe that overall the economy is starting to rebound. And this is shown with both unemployment and inflation moving back towards their dual mandate goals.
So as we see here, this is a graph depicting the Fed's balance sheet. From this graph, we can conclude that over time, the Fed's total assets has increased, but has increased dramatically over the year of 2020. This year, the coronavirus has tested the tools of the Federal Reserve in maintaining the dual mandate using monetary policy. This is why we believe continuing purchasing of mortgage-backed securities will be beneficial to the economy.
Moving on to the developments in the economic situation. Given the consistently low inflation, the Fed has adopted an inflation averaging strategy with a short-term goal above 2%, with the long-term goal of 2% target inflation. Initial claims, which at the beginning of the pandemic hit historic highs, have begun to decrease, but still remain well above pre-pandemic levels. Despite the economic setbacks, U.S. households' net worth rebounded to an all-time high in the second quarter of 2020. U.S. trade has significantly decreased in 2020, reaching its lowest point since 2008, with the trade balance currently sitting at negative $63 billion. The U.S. dollar measured on the trade-weighted index, though, has begun to rebound despite its fall in May. On to the financial situation.
As you can see here, the financial markets underwent a correction during the height of the COVID-19 pandemic and the resulting economic shutdown. To cite subsequent financial market rallies following its sharp decline in March 2020, the financial markets have remained volatile among a variety of uncertainties, including a second wave of coronavirus infections and the upcoming presidential election.
This slide shows the VIX and the CAPE ratios, which are two ratios used to determine the outlook of the stock market. This is a supplemental slide showing that perhaps due to the VIX's increase in the month of March and then falling back down as paired with the CAPE ratio showing a drop at around the same time, we can conclude that investors had quite a shock, but are still feeling that uncertainty felt at the pre-coronavirus levels. The fluctuation is price. Slide 10 is a graph showing the yield spread of the 10-year minus the 2-year and the 10-year minus the 3-month. A closer analysis shows that the last inverted yield curve did not predict a recession, but we did see the 10-year minus the 3-month take a dip into the negative range. Furthermore, we can see a larger difference between the 20-year minus the 2-year spread.
These changes in yield spreads are largely due to interest rate increases or decreases. On slide 11, we can see that the short-term interest rate sharply declined during the first quarter of 2020, likely due to COVID-19. The Fed has displayed concern on the worryful nature of low interest rates in regards to economic growth, as we see a 4-year increase in the short-term interest rate between 2016 and 2020, from a low of 0.75% to a high of 2.8%. Current forward guidance on this matter is currently to maintain a low interest rate between 0 to 0.5%. This is done to hope to stimulate investment as well as to stimulate economic growth in a time of uncertainty. Furthermore, we can see on slide 12, we see that the long-term interest rates on bonds has seen a decrease, but it has also been declining like this since 2008. Until the Fed's goals for the monetary growth are met, we are not likely to see immediate change. However, the Fed has been outspoken in their long-term interest rate goal of 2%, which meets the neutral rate of inflation. Next, we will talk about the economic situation.
GDP growth declined at a historically rapid rate in the second quarter of 2020 in the wake of the economic shutdown. Real GDP growth will continue to be monitored by the Federal Reserve and the FOMC, and the entity's projections of this economic indicator remain optimistic with the positive implications from recent fiscal and monetary policy. However, factors of further spread of the coronavirus, the slow and scaling back of statewide economies reopening, and the uncertainty of future fiscal stimulus leaves the measurement subject to recovery or further contraction in the next coming months. While consumer spending remained well below pre-pandemic levels, real PCE rebounded strongly in May from an 1,800-point drop in April, driven by strong growth in consumer spending, particularly a continued increase in spending on non-durable goods and a moderate increase in spending on durable goods. High-frequency indicators show that spending on services most closely tied with human interaction, like food service, hospitality, and travel, still remain low. Levels of consumption will continue to rely heavily on the path of coronavirus and the availability of fiscal stimulus.
For the note with the households, we saw a decrease due to government lockdowns and job losses, mainly due to the coronavirus. But since then, monetary policy tools and fiscal policy actions like the CARES Act and quantitative easing have allowed the net with the households to rebound back above pre-coronavirus levels. This supports our monetary policy recommendation to continue to maintain current rates of purchasing securities through quantitative easing to continue providing credit flows to households. Next, we saw real DPI have a sharp increase, mainly due to the fiscal policy actions by the federal government with the CARES Act, providing stimulus and unemployment benefits to to tons of Americans across the country. But as soon as that CARES Act expired, we saw just as quick of a decrease, and this is a risk that we want to keep in account going forward with fiscal policy uncertainty about if we will have another CARES Act, any furthermore aid to the American people.
University of Michigan's survey of consumer sentiment fell sharply in the second quarter of 2020, although the Consumer Confidence Index rose to base level, overall indicating weak consumer expectations about the future and current economic situation.
After analyzing the consumer, let's look at real gross domestic investment, which saw an increase after the Great Recession in 2008. But as seen on this slide, a sharp decline occurred in the first quarter of 2020, likely due to COVID-19. The Fed's goal is to revitalize the economy, and the reduction in the decrease of real gross domestic investment shows that the Fed's current management has been effective in minimizing the economic aftershocks caused by the pandemic. A business sector that is currently displaying a comeback is the housing market, as we can see on slide 20. After a sharp initial decline, starts and permits on housing have almost returned to pre-pandemic levels. The S&P indicates a monthly increase by 8% between June and July, according to Will Parker from the Wall Street Journal. The resurgence in the house market may indicate that confidence in durable goods is returning, which is a promising aspect for the economy.
Manufacturing new orders. This graph shows an increasing number of new orders in the manufacturing sector, not accounting for non-defense and aircraft spending. Points to an increase in consumer demand and allows forecasting a near-term increase in production activity as the economy starts to pick up. Next slide. This graph shows the overall net decrease in cash flow with a slight increase in recovery due to the possible fiscal stimulus felt this year.
Both imports and exports decreased significantly with a current trade deficit of negative $63 billion. This fall in net trade is due to the COVID-19, global uncertainty, and global slowdown, and the varied responses by different nations to the COVID-19.
Next, moving on to unemployment. Here we can observe that both U3 and U6 spiked significantly during the second quarter of 2020, showing a 127 and 97% change from a year ago, respectively. The slack in the labor market is clearly present with a discrepancy of 5.8% between U6 and U3. This shows the shortfall between workers' desired amount of work and the amount of actual work available. These rates have been steadily declining since May, but are still far above the relative levels from the beginning of the year. In our top graph, we can see the labor market activity decrease significantly as a result of COVID-19, causing many businesses and firms to close. This results in a sharp decrease of hires, quits, and openings. Our bottom graph recalls a similar story, with unemployment claims recording record highs. That being said, once the businesses started to reopen and COVID-19 regulations became less stringent, a lot more movement is seen in these categories. Businesses started hiring again and openings became more readily available. Unemployment claims, while still increasing, with 837,000 claims being filed just last week, they began to see a much slower decrease in July and August compared to May and June. The peculiar trend of current openings to hiring ratio will be elaborated on later in our presentation. Once the economy started to pick up its steam, it's clear that this increase in quits portrayed that individuals felt comfortable enough in their financial situation to pursue other opportunities. And in conjunction with the decreasing rate of claims filed, this displays the signs of what has been indicated here today, an economy approaching recovery. Per the Federal Reserve's initiative to recognize demographics that are more heavily impacted by the fluctuations in economic activity and analyze these experiences to create solutions, we felt it pertinent to display this comparative graph. It's widely acknowledged that the COVID-19 pandemic has brought hardship and economic disparities on some communities more than others. This monthly figure shows the unemployment rate broken down by race. During the early stages of the economic shutdown, Hispanics were most adversely affected at an unemployment rate of 18.9% in May. African Americans and Blacks experienced an unemployment rate of 16.8%, the rate decreasing much slower than other demographics during the remainder of these months. While these other demographics continue to have elevated levels of employment, white Americans record the lowest unemployment of August 2020 at 7.3%. It's imperative to include this data when considering our policy recommendation to ensure that our suggestions are inclusive and effectively support communities hardest hit by COVID-19.
To go off what Josh just said, we saw a steep increase in real wage rate, mainly due to lower income workers or lower wage workers, that mainly jobs that typically held by more minorities than whites. This decrease results in the average earnings to increase due to more high income workers that still retain their jobs, which overall skews the average of this up. This also could have been increased due to a decrease in inflation, since nominal wage divided by inflation would give you the real wage rate. And overall, this shows the importance of continuing to supply credit through quantitative easing to households, which include these low wage workers. And next, we want to take a look at the labor force participation rate. Overall, this had a very sharp decrease as soon as coronavirus hit, and also maybe some workers didn't want to work due to unemployment benefits that they would have been given if they weren't working. Also, but since that has gone away and also government lockdowns and restrictions have eased up, we are now seeing that the labor force participation rate is starting to kick back up, which is a promising sign for the economy that more people are participating in the labor force now.
The Beveridge curve helps bridge a gap between hirings, openings, and the labor participation rate, and it shows an unusual trend due to COVID-19. The initial shock from the pandemic caused a drastic increase in unemployment with virtually zero change in job openings. This is unusual. Typically, no change in openings indicates very little change in the employment rate. But the pandemic has caused a strange shift that is uncharacteristic of the typical business cycle. Health risks to workers, stimulus, and increased layoffs complemented by lower revenue streams for businesses assist in understanding why the Beveridge curve might be shaped this way. The last 4 years have characteristically shown inflation as an average of 2%, as seen in the next slide. This is historically consistent because the Fed tries to preserve economic stability. But in the last 2 quarters, this has really changed.
Current inflation has increased as we see an increase in demand. Next slide. We can see 3 variables impacting this graph. First, the 5-year expected inflation, the University of Michigan short-term expected inflation, and the 10-year break-even inflation on investments. These variables have increased as of July. However, the 5 to 10-year outlook is not perceived to increase.
And next, we have the economic outlook.
Moving ahead, we forecast the unemployment rate to decline back towards the natural rate, with our long-term forecast at 4.5%. We expect real GDP to maintain its negative rate, rebounding in 2021 and 2022, with our long-term forecast settling at 2%. Both PCE and core PCE are expected to climb slightly above the targeted goal of 2%, with our long-run estimates of 2% PCE and core PCE. The current lack of stimulus and unemployment benefits continue to hinder sustained growth. The upcoming election also adds to market uncertainty. Currently, there is no readily available vaccine for the COVID-19, increasing the risk for potential future outbreaks. Should a vaccine be released soon, the consistent reopening will boost growth in the market. Mortgage rates have also increased the risk for potential asset bubble, with the 30-year fixed rate mortgage remaining at a historic low.
To finish up, we would like to reinstate our policy recommendations as to maintain the Fed funds rate between 0 and 0.25%, to continue providing forward guidance regarding monetary policy decisions in accordance to the dual mandate, and we would also like to maintain current rate of purchasing securities in order to sustain market functioning and to make sure that the credit flows to households and firms are supplied.
And thank you. That was our presentation. Have a nice day.